Federal Reserve's next meeting starts tomorrow. Much of Wall Street expecting a pause in interest rate increases, but some still think a hike is on the table. Joining us right now to talk about that and much more is Kevin Warsh. He is a former Fed governor and a Hoover Institution visiting fellow. His latest op-ed for the Wall Street Journal talks about the fallout from the Silicon Valley Bank collapse and says that without a change in policy, the U.S. banks could face a slowdown and need even more government support. Kevin, first of all, thank you for coming in and taking the time to talk with us today. I want to start with your op-ed, and then we'll get to the Fed, because what I took out of this is, look out. You thought we were done with the problems in the banking sector. You could be completely wrong. You want to lay out the risks that we're still facing and what worries you about it?
Sure, Becky. Thanks very much for being here, for having me with you. So I might be too scarred by the 2008 financial crisis. I don't mean to suggest that we're on the front end of what we all experienced back then. But this is a time where markets are giving the Fed a free look. The markets have been benign since the crises of 5 and 8 weeks ago. And my sense today is they should do what we should have done during this period of calm on this day in 2008 and buy some insurance. The way I look at things, we are unlikely to be in some durable, strong economy where we should be certain of the future. We should buy some insurance. There should be some risk management. In the event things don't go well, we should use this moment to protect ourselves and protect the banking system. And so what I outline in the op-ed is simply to suggest that the market structure of banking, with a few very large institutions at the top and 4,000 institutions below them struggling to figure out how to have profitable business models, this is not a great environment, and the Fed should do a couple of things to try to strengthen the banking system. So on the other side of this, we've got credit that can go to small and medium-sized businesses, and they don't have to go to extraordinary lengths if bad things happen.
So let's just lay out the list of risks that you tick off. It's not anything we don't know, but it's probably worth looking at them again. Just the idea that you're going to see deposit costs set to increase. I think you said it would siphon something like $60 to $80 billion at least off of profitability from the banks coming up. You've got a credit crunch that's facing us. You have the commercial real estate situation, and then you've got a Federal Reserve that could raise rates to 6%, and all of that could add up to some big problems and some rough waters ahead.
Yeah, so you said it better than I can.
I just took it out of your piece.
There's a normal lag between the time that interest rates go up, and we see that in funding costs. We see that in deposit rates, especially when during crises, consumers say, I'm uncomfortable with my local bank. I better bring my deposits to one of the too big to fail institutions that might be charging only 30 or 40 basis points for the right to put cash there. I think there's a lag, and I think almost all businesses and households are going to be looking for higher yields. About 70% of all deposits today, Becky, are non-interest bearing. I don't think that's going to last for much longer. So the banking business is going to be subject to greater risks. It's going to be harder to make money. Profitability could eat into capital. And the good news is over the last 5 weeks, banking stocks are doing well. Lending seems to be hanging in there. And my instinct is the Fed should use this window of opportunity to try to make sure these other institutions won't just survive, but thrive. And so I suggest two things. Joe, as I came on the set, said that I was a strident critic. I'd like to think I'm a constructive critic. So the two ideas are quite simple. Take capital from all comers. There's a lot of capital on the sidelines from asset managers, private equity firms. They want to invest in the business of banking. If we don't let them in the formal banking system, they'll be in the shadow banking system. The Fed needs to welcome them. This is capital that would be well received. Even if bad things don't happen to the broad financial markets, we need these banks to be on their front foot to provide credit. And the second thing's also a big, important change in policy that I'm advocating for Chair Powell and Secretary Yellen. They should allow some consolidation. They let the big banks get bigger and bigger. These small and medium-sized banks, Becky, they need to be able to compete. Let them do mergers. Let them get some greater franchise value, get some scale and scope so they can compete against the big guys. Market structure is almost everything in every industry that comes on your show, and I don't think this market structure looks as sustainable as the Fed thinks.
We just had Roger Ferguson on, and he thinks that the Fed is probably more likely to raise rates at least twice because of these concerns about inflation. But he shares your concern that the banking situation, the banking woes are not over. I think I forgot about Bear Stearns being the big one that went down in March of 2008. Stocks stabilized over the summer. Things looked OK. And it wasn't until the fall of 2008 that things looked much, much worse. And we saw the contagion effect. How big of a concern is this for you? Do you think the Fed should continue to raise rates?
So I love Roger. We overlapped for about a year. On his last day as vice chairman of the Fed, he came to me with all these old files, and he stuck them on my desk, and he said, Kevin, these are your problems now. So I always take what he has to say quite seriously. It's hard for me to judge what the risks are that we have a big banking crisis 3 or 4 months from now. It's easy for me to say this is a good time for risk management. The Fed seems strongly inclined to continue to raise rates. The last time that Chairman Powell threatened to raise rates to 6% was the Tuesday before this banking crisis, in testimony before the Senate Banking Committee, and 48 hours later we were in the soup. It wouldn't surprise me at all if there weren't a couple of dots in these forecasts that my friends at the Fed insist on keep publishing at their meeting later this week. And it's not obvious to me markets have fully internalized that. So I take those risks seriously. And when you can buy insurance cheap, which is what the Fed can do by changing their regulatory policies right now, I'm all for buying it. Again, I share the consensus view, and I think it was Roger's view, that they're going to stand down, not take any policy action this week. But I hope that they do more than that. I hope that they decide to be introspective.